Market to Market is everywhere you are. Subscribe to Market on YouTube, find us on the PBS video app to stream on demand, and add our 3 podcasts on your favorite podcasting app.
Coming up on Market to Market, the Phase 1 report card reveals a need for improvement. Early debate on the new Farm Bill includes familiar themes. The fight over water rights in the High Plains. And market analysis with Dan Hueber next.
What's the most complex industry on Earth? It's not genetics, or meteorology, or logistics. It's a business that involves them all. It's farming. Thank you, farmers, from Pioneer.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, February 11 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. The bipartisan Ocean Shipping Reform Act, introduced in the Senate this week, looks to help American exporters in the international shipping industry. But the World Shipping Council calls the House version, which already has passed, a political statement of frustration. The world's largest shipping company, A.P. Moller-Maersk of Denmark, says 2021 was the most profitable year yet, with $18.7 billion coming in before taxes. Americans kept buying foreign-made products at a faster pace than domestic goods, as the 2021 trade deficit set a record at $859 billion. The Consumer Price Index moved higher in January by 0.6%. The core CPI moved at the same pace. And when you look at the year-over-year rate of inflation, the increase was 7.5%, the biggest jump in 40 years. A nearly 2-week-old protest among truck drivers over Canada's COVID-19 restrictions has now bottled up the Ambassador Bridge connecting Detroit and Windsor. The crossing carries 25% of all trade between the two countries and has forced the closure of some auto plants over parts shortages. Restrictions on trade with another U.S. partner, intended to force a different result, has yielded a lower than expected outcome. Josh Bittner reports.
This week, the Peterson Institute for International Economics lambasted the former administration's 2019 Phase 1 agreement with China, which brought a halt to Trump's trade war, but failed to deliver by a December 31st, 2021 deadline. The DC-based independent nonprofit research organization says China bought only 57% of initial U.S. exports they committed to purchase over 2020 and 2021. Trade officials brokered Phase 1 based on 2017 pre-trade war American export numbers.
This is number 1, but this is the first of many.
But after 18 months of tariffs aimed at decoupling the two economies, Peterson senior fellow Chad Bown wrote U.S. exporters had to dig out of a $13.6 billion hole first before China could begin chipping away at the extra $200 billion they pledged to purchase, effectively buying no additional goods.
Rather than crying over spilled milk, and I said the virus might have something to do with it, but maybe even if we didn't have the virus, Chinese aren't known for keeping their word.
While farm states suffered retaliatory Chinese tariffs in 2018 and 19, Trump directed tens of billions in taxpayer-funded bailout money to help level the playing field for agriculture.
The farmers are going to have to go out and buy much larger tractors because it means a lot of business, a tremendous amount of business.
But pandemic, recession, resulting supply chain issues, and inflation all sank the larger deal, backloaded for 60% purchase increases in 2021. Though some tariffs carried over between presidencies, Peterson largely gives the current administration a pass, saying China was never on pace to meet the terms, even projecting overall U.S. exports would have been almost $40 billion higher over the past 2 years without the trade war or Phase 1. For Market to Market, I'm Josh Bittner.
The process to write the next farm bill has entered the phase questioning the current administration's climate change plans. Peter Tubbs again looks at the process from Capitol Hill.
The fact-finding process of writing the 2023 Farm Bill continued this week as members of the House Agriculture Committee probed where the farm programs that serve rural America need to be adjusted. Several representatives had questions about the Biden administration's climate change initiatives.
Why are we taking our eye off the ball on feeding America in the most efficient way and the safest way, and all of this noise about climate change? I mean, like I said, my people are not talking about climate change.
When I go out in the countryside, I hear about drought, I hear about wildfire, I hear about extreme weather events. And part of our effort to address those things is about climate change as well, and is making U.S. agriculture more resilient.
How is a farmer supposed to look and say, great, here's another program for us to jump through because somebody wants to worry about carbon? So, Undersecretary, how's a farmer going to look at this?
So this is voluntary, and farmers can decide for themselves whether it fits into their own production and whether it provides value. Our interest here is actually providing value, create new markets, new opportunities, new sources of income, and to de-risk it in a way that allows producers to step into that. It won't work for everybody, but we think it'll work for a potentially large slice of agriculture.
Delivery of crop insurance payouts were also a point of emphasis.
I know some have proposed eliminating the private sector-based delivery system. Any observations on that?
I think the public-private partnership is a great delivery mechanism. And as you point out, we can move quickly. You can turn on assistance very quickly, and that's very attractive.
The number of tillable acres that are enrolled in conservation programs, such as CRP, may be tweaked in the new Farm Bill.
In your mind, why is so much good productive farmland ending up in CRP? And what is USDA doing to achieve the shared goal of reserving CRP for the most environmentally sensitive acres that need to be in the program?
It's a voluntary program. Landowners are going to enroll what they're going to enroll, but we can do things through targeted enrollments, continuous enrollments, partnerships through CREP that can make sure we get those lands that are really environmentally sensitive.
For Market to Market, I'm Peter Tubbs.
The temperature at kickoff inside the LA Coliseum for Super Bowl VII was 84 degrees, and that record from 1973 could fall as this year's installment of the game takes place 6 miles south in Inglewood. A warm west is nothing new, and neither are dry conditions. But the pairing has renewed a big clash over water rights. John Torpy explores the debate in Colorado in this week's cover story.
At the Colorado Department of Agriculture, we are eyes wide open that we are dealing with a real climate crisis, and agriculture is among the first impacted. We've got folks.
Colorado Commissioner of Agriculture Kate Greenberg is well aware that this climate crisis has impacted farmers in the eastern part of the state. Each year, those farmers play a waiting game to learn how much water will be in their allotment. Mark Arnish is a third-generation eastern Colorado farmer, working the land purchased by his grandfather, who emigrated from Austria in 1952.
The underpinning water supply that we depend upon year over year is from the South Platte River. And imagine not knowing what you could do on your farm because you didn't know what your allocation was for water.
The start of that waiting game goes back to 1923, when Colorado and Nebraska ratified a water-sharing agreement involving the South Platte River. One section of this interstate compact allows Nebraska to develop a canal in Colorado to divert water from the South Platte River for irrigation on farms in the western part of the Cornhusker State. While the canal was never built, authorities in Nebraska are taking a close look at the idea. Kevin Ryan is the director of the Colorado Division of Water Resources.
And the compact recognizes that during the irrigation season, that is between April 1st and October 15th, we'll measure that flow And if that flow is above 120 cubic feet per second, then there is really no action to take.
There's a hierarchy for water in the two states, with senior water rights, all operations with allotment agreements started before 1897, and junior water rights, all those operators who started after that year. Drought conditions can interfere with the seamless allotment of obligated water as the compact puts a priority on farmers with senior water rights.
The flow drops below 120 cubic feet per second, then Colorado needs to curtail water rights on the lower end of the South Platte. If we curtail those water rights, then we are in compliance with the compact during the irrigation season.
One season of cutbacks in water allotments can seriously affect a farmer's bottom line. The agreement arranged between Nebraska and Colorado is one of 9 interstate compacts the Centennial State has with neighboring states.
We're a headwater state. We're responsible for delivering water to many states and the country of Mexico downriver from us. That adds yet another layer to our responsibility as a headwater state and to the challenges that we see with hydrological drought.
Officials with the Colorado Department of Water Resources note when drought conditions are low, these water sharing agreements rarely become a long drawn-out issue. As D3 and D4 drought conditions continue for Colorado in 2022, farmers continue to worry about how much water will be available for this and future growing seasons.
We have a lot of competing interests for our water here in Colorado, not just amongst commodities, but even with the urban-rural divide that we have here. Within agriculture, we try to add value to our water, whether that's growing a value-added crop, being a little bit divergent in the marketplace. But here on our farm, we're trying to add value by creating markets.
Creating those additional markets can be a struggle when farmers have to fallow fields and still attempt to make the remaining acres cover the loss.
When we idle acres, it's like a death by 1,000 paper cuts. You know, we still have those overhead costs. We still have taxes to pay. We still have the carry cost of that land for that year, and yet we're not going to have a crop until the following year. But it helps us be better managers. It helps us be better planners, and it helps us to think out 2 and 3 years instead of just trying to, provide that crop this year. Drought is something that I've had to deal with almost my entire farming career. That goes with farming in the high plains of eastern Colorado. We rely upon snowmelt. We rely upon a lot of weather from time to time. So in the 25 years that I've been farming, drought seems like it's just right around every corner.
Arnish and his family farm around 2,200 acres in what's called Prospect Valley, a diverse agricultural area located 45 miles northeast of Denver. Arnish has been forced to change the makeup of his row crop farm 9 times to adapt to the changing climate.
Water touches everything here in eastern Colorado, and the way our rules and regulations have changed over time in Colorado are really impacting my farm.
Noting changes in the amount of available water, Arnish has changed his business plan to growing certified seed wheat, certified seed grains for the spirit and beer industry, and value-added feed ingredients.
We're trying to be different in the marketplace. I wouldn't say niche, I would say value-added. But the things that we do on our farm that are rewarding us and rewarding the value of our water.
With the La Nina weather pattern currently calling the shots for the coming spring and summer, farmers and ranchers in eastern Colorado may have to continue the same kind of flexible approach.
And our agricultural community is at the front lines of all of those issues: climate change, persistent ongoing drought, and making sure we are meeting our obligations to other states in the country of Mexico in a way that also helps preserve and advance agriculture.
For Market to Market, I'm John Torpy.
Next, the Market to Market report.
The USDA report pegs South America's crop as smaller than earlier predicted, and the market reaction was neutral. For the week, the nearby wheat contract added 37 cents, while March corn jumped 31 cents. Thursday's trade range for soybeans was dramatic, touching highs before a big reversal. Following CONAB's Brazilian bean production estimate, the March soybean contract gained 30 cents. March meal strengthened $12.70 per ton. March cotton shrank by $1.46 per hundredweight. Over in the dairy parlor, March Class 3 milk futures expanded 99 cents. A mixed week in the livestock sector. April cattle declined 70 cents. March feeders put on 13 cents, and the April lean hog contract moved 2.15 higher. In the currency markets, the U.S. dollar index added 60 ticks. March crude oil advanced by $1.08 per barrel. COMEX gold rose by $56 per ounce, and the Goldman Sachs commodity index bumped up almost 4 points to finish at 648.60. Joining us now to provide some insight is Dan Hueber. And Dan, you come in at a time when I'd say at 11 o'clock Friday morning, I was all ready to say, let's start with soybeans.
Sure.
But then there's a report of Russia is going to invade Ukraine.
Right.
The market all of a sudden takes off back up, which was going to be a pretty flat day. We start with wheat because that initially was going to be the big reactionary commodity if an invasion happens. Is that still accurate information that that's the market to face the biggest impact?
Well, it for the day, certainly. And again, uncertainty just breeds people taking risk off. People who are end users who need product will tend to cover themselves in fear of something of that nature. Again, let's hope it doesn't happen next week, but on the same token, I think if it does, we're not going to see necessarily that big of a market reaction. So you go back 8 years ago when the similar thing happened, when Russia went into Crimea, markets panicked, we had a lot of uncertainty. Is it going to disrupt exports? And, within a day or two, we'd pretty well settled down even after the invasion. So.
Prior to Friday, there was a report that Russia is poised to make billions and billions of dollars on crude oil on all of this run-up.
Certainly. This has already been I think the official Russian energy agency posted record profits here this last year. So absolutely, this has been a real boon for them. And realistically, had we not seen this kind of inflationary push in the commodities in the last year, they might not have had the wherewithal to really even stage such an event. So.
Let's finish up wheat and kind of put a bow on it and actually talk about it, because we're talking about all these geopolitical things going on with it. What are you doing right now in this, if I've got wheat still hanging around?
When you look at the wheat market, really for the last 8 weeks now, we've really gone nowhere. It's just a back and forth market, kind of gets tugged around with what happens with the corn and beans, where the big story, of course, has been driven by South America. I tend to still look at where wheat is. When you're hovering around the $8 mark, by no means should that be considered a poor price to take. I still think you sell into this market, both old and new, if you have the old, and do some pricing on the new. The fundamentals on wheat, they changed dramatically in the last year, but they've really kind of stagnated. In fact, the reports out this week, if anything, were a little bit higher world carryout than was expected. Australia looks pretty good at this point, so you're not really looking at any real major trouble spots, other than some possible winter kill in the winter wheat, or in the U.S. wheat. So I think you still take advantage of the prices where they're at right now.
We are talking weather when it comes to corn. South America crop, USDA, as we mentioned, lowering the estimate. What's that doing to corn specifically?
Yes.
In South America, South American weather.
And again, nobody has really done dramatic reductions in the South American crops yet. The Brazilian beans are coming out, the early beans are coming out at a pretty rapid pace. Yes, the yields are not necessarily what people would have desired or expected initially, but that also means that the second corn crop is getting into the ground pretty readily. The weather in southern Brazil is still a little bit iffy, at least for the next 10 days. But beyond that, at least the weather forecast I've read say that starts to clear up again. So, they really could come back with a fairly decent second crop. And even in Argentina, the crop is pretty well planted down there at this point. But in the major growing regions, not necessarily as adversely impacted as maybe the markets in a whole would make us think at this point in time. So,
what are we doing here on the new crop side for corn?
Similar thing. You're pushing the $6 area. I think when we look historically, yes, we know corn, nearby corn's more in the $6.50 range, but at $6 corn, traditionally, that is an exceptional price level. And really, this is really only second time in history we've been in this range. Granted, we know inputs have escalated pretty dramatically, but here again, I think at $6, you need to start looking at what kind of return am I looking at my operation? How do I lock this in most effectively, including your input cost? If you're making money, I think you just need to sell into it. And when you get in emotional markets like this, I mean, no one realistically knows, one, how big the damages are in South America, and two, just how high is high. Have we really factored it in already? The action this week would probably say no. We're still in that process of trying to adjust to those lower crops. But that said, nobody knows how to pick the high. You have to look at your profitability and make your decisions based on that.
Well, let's take Glenn in Ohio's question right now, because it's related to both corn and for sure what we're going to get into soybeans.
Sure.
Glenn wrote us via Twitter, and this is what he says. It's, if we take into consideration the current rate of inflation in our economy, factor in the foreign countries and exchange rates that we compete against, how far out into the future should a producer hedge his costs and sales to offset the potential downside risk?
I really, of course, 2022 is a slam dunk. I think you can pretty well lock in whatever your costs are for 2022. Granted, you don't know exactly what your profitability would be as far as yield-wise. Crop insurance is going to lay a pretty good foundation there. I don't see any reason not to be a relatively aggressive market there. Looking out to 2023, I think you start dabbling there. Inflation is an unknown. Granted, we can't say anymore that it's transitory. I mean, the Fed said we can't use that word anymore, and it hasn't been. It's hung on much longer than anybody anticipated. But really, when you look at some of the elements that have been pushing inflation higher, such as used car prices, it's probably not as direct of an impact as we'd like to see when we see the headline 7.5% inflation. But we know the Fed is ready to act and may act even more aggressively than we might anticipate with some of the rate hikes. We're almost certainly going to see a rate hike next week or next month. And, keep in mind that, once you start seeing rate hikes, what does that do to the dollar? Well, it tends to make the dollar go higher. Going to make us a little less competitive on the world market, so it can be a negative impact.
And things can disappear quickly. Let's take a look at Thursday's bean market as an example. So if you are watching what happened on Thursday, you take a lunch, come back, how am I protecting myself when I'm way into the 16s?
Oh, exactly. Yeah. The other aspect there is, markets never ever find a peak because the news turned bearish. It happens just because we have basically adjusted for whatever the supply-demand fundamentals are out there. We have basically overcompensated for where they should be, and they turn down on their own weight, not because the news is almost always going to be the most bullish when you find a peak in the market. And I haven't found anybody yet over the last 45 years I've been in the business that can accurately tell us exactly where that's going to be.
Only one person hits the top, right? Usually, only one hits the top.
Well, that's the one who's liquidating.
Right.
Yeah, getting squeezed out of a short, so, yeah.
All right, we have to finish beans and plus, but I need to get to the meats because they are still being, dealing with their own things. Feed costs, live cattle, the processing. What do you see happening in that market?
Well, and of course, we've had a pretty explosive rally in both cattle and hogs as of late. This is really the highest we've seen April cattle in several. In fact, over on spot cattle, we haven't really had spot cattle above 142 for years. So we've actually taken that level out. I don't think it's necessarily unrealistic to see things move up towards the 150 range. In the hog market, here an explosive rally in the hogs over the last 4 to 5 weeks, pushing 107. Interestingly enough, we look back historically, and the last time we had April hogs above 147, we pushed all the way to 120. Now, not saying that has to happen again, but I think part of it's demand, part of it's inflationary, part of it is compensating for the increased input costs that we have to deal with at this point. So
yeah, I think hogs, that's at least $7 here in the last 2 weeks that we've moved. And if we're going to 120, that's $18 to go. That's a heck of a run.
Yes,
so if I'm a hog producer, am I expanding right now if I can?
Well, I don't know if I would base my decision on what's happening today. And again, we have to look long term. So I think if it works in your cash flow and you have the wherewithal and you don't have the neighbors that are opposing you, it's why not? I think the demand for meats is going to remain pretty solid as we move forward. So
what about in the feeder cattle market? If I had that opportunity to go to the sale barn tomorrow and make a purchase?
My outlook on the fats into this year, I think, is still pretty strong. So I think, yes, if you have an opportunity to have some more cattle out there, then certainly there's going to be a market for them.
All right, as we wrap up in the final seconds here, cotton, is this still a little bit of a sell-off this week, but we're still in incredible territory? Have they bought all their acres?
Well, I don't think they bought the acres. I think that is the thing. We've got probably another 60 days before we really have determined who's going to win the battle for acres this spring. So cotton's been acting a little bit sluggish, particularly in the last 2 weeks here. But that said, it's difficult to imagine that we're going to really get much pressure here, at least until we have a better handle on what the acreage battle is.
And do you cite as, is this a weather or a trade issue right now that's been running cotton?
Oh, I think it's, well, I mean, to the rally to this point, oh, I think it's been trade. I think the demand's been solid enough, but now it's a question mark, can we keep the acreage up there? And I think a lot of people to the south would tend to want to stay with cotton if they could over soybeans, but yeah.
We'll continue your thought process. We'll get back to soybeans, and I got a couple other questions that I think you're going to enjoy. Thanks, Dan.
Very good.
That will do it for this installment of Market to Market. We will talk more on Market Plus with Mr. Dan Hueber, so you can join us there. Find that on our website of markettomarket.org. And a little secret of the show, what you just heard is our market analysis and is available in podcast form. And so will the extra session that's not on TV, our Market Plus. And Tuesday's conversation around topics that we cover is on the program we call MTOM. Follow all three today to stay in the know. Next week, the push to end famine. Thank you for watching. Have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's the most complex industry on Earth? It's not genetics, or meteorology, or logistics. It's a business that involves them all. It's farming. Thank you, farmers, from Pioneer.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.